Drinking spirits almost always seems like a good idea at the time. For the first few drinks, the more you have, the better you feel. But if you're not careful, there comes a point when you realise you've had far too much, and by then it's too late. Dizziness, sickness, and the mothers of all hangovers set in. And as it happens, I have got a feeling that the same process may be underway in the share price of Diageo, the world's largest distiller. Diageo is the maker of such premium poisons as Johnny Walker Scotch, Smirnoff Vodka, Captain Morgan Rum, and Jose Cuervo Tequila. And as you can see from its price chart here, going back over the last 3-4 years or so, there is a party in full swing here. Diageo's share price has recently hit an all-time high of around £18 and 9p, having risen from less than £11 just last August or so. And this is a lovely steady uptrend for my money. Just the sort of thing which is good for tactical spread betting positions, because you get these nice strong advances interspersed with fairly mild pullbacks, allowing you to jump on the trend, jump aboard and catch the next leg higher. And I have to admit, for now, there are no signs of a major top. This looks like yet another one of these mild pullbacks along the way. But there are a couple of things which are bothering me with Diageo right now. One is a fundamental point. The dividend yield on Diageo has dipped to around 2.4%, which is fairly low compared to its past. And in the past, low dividend yields on Diageo have often foretold double-digit share declines in the share price over the coming 12 months or so. So that's one thing that makes me cautious. The other thing is if we look at the monthly chart of Diageo, which you can see here, and so up here we've got the price, and down here we have the monthly relative strength index. And the relative strength index has hit a high just lately of around 87%. And that is absolutely eye-watering stuff. This price has not been as overbought as this any time in the last 20 years or so. And extreme overboughtness, or at least a state of overboughtness, has often led to big declines in the past here. If we look at the top of 2007, you can see that that was preceded by overboughtness, or albeit nothing as bad as we've got at the moment. And obviously we had a big sell-off here. Then a similar picture in 2002, another big sell-off preceded by fairly modest overboughtness, and the same applies in the late 90s before this big sell-off that we got here, overbought conditions. So this is a sort of thing which makes me very, very nervous indeed about how much this can really continue. So I have to ask at this point, how far can this go? And the first thing I'd say is certainly from a tactical or investment point of view, I really wouldn't be interested in this at these sort of levels. This uptrend is now a pure investment or pure momentum play, something you just buy in the hope of further near-term gains. But I think the upside-downside ratio, the potential falls now far outweigh the scope for this to rise even further. So, however, I'm not stupid, at least I'm like to think I'm not, and I would not want to stand in the way of something which is still rising strongly. So, what will be the signs that the big sell-off, which I'm predicting, has begun? And what I would be looking for is for the share price to fall below this blue line here, being the 55-day exponential moving average. And the second thing I'd then want to see is for the pink line, which is the 13-day exponential moving average, cross beneath that 55 exponential moving average. And thereafter, what I would be looking to do is to short the price as it rallied either to around this 50, probably to the 13-day moving average, and then as it drops back through that line, I would be looking for it for short positions. That would be my trigger point. So I think at the moment, just to summarize, I wouldn't be opening short positions anything like here yet. But when once the setup I've got occurs, I think that Diageo shareholders could be facing declines of more than 20% in the share price, and that really would be a bear market with a sore head.